So the housing market so far in 2022 is like a 5,000-piece jigsaw puzzle. Homes are becoming less and less affordable, and some argue that they've already been that way for quite some time. According to data from Goldman Sachs, the monthly median mortgage payment is up almost 56% year over year. That means if you're in the market for a new home, just a year ago on the same house you would have paid $1,100 for a monthly payment for, now you're looking at closer to a $1,700 monthly mortgage payment. While homes are less affordable, home prices across the board are still high compared to the past year, with home prices up around 11% year to date and up 44% since the pandemic. The data is also showing that even with this price appreciation, the rate at which it's appreciating is starting to cool off. That is most attributed to the crazy environment that we're in. We have interest rates hitting their largest yearly increase in the 30-year mortgage rate. We'll explain what that means today. We also have inflation running at 8%. There's a war going on overseas, and gas prices are still at all-time highs. The stock market remains down 18 to 20% year to date, and the cryptocurrency markets, well, they're nowhere really to be found compared to last year. So many people naturally think that the housing market is going to crash next, but in this video, we're gonna uncover a few factors with data as to why many experts don't believe that the housing market will crash. Cool off? Yes, but ultimately crash? No. It's a puzzling situation, but by the end of this video, we're gonna make sense of it in the simplest of terms, and that 5,000-piece puzzle will be complete. You'll be able to brag to your friends that you put a puzzle together in one day, even though the box says 2 to 4 years. You'll have a clear understanding of how we got here, where the housing market stands today, and what it means for you, especially if you're in the market for a home like I am. All right, so make sure you thumbs up the video, especially if you like that puzzle joke, and let's talk about how we got here. So prior to the pandemic, the 30-year US fixed mortgage rate was sitting right around the 3.5% interest rate level. The interest rate is the cost to borrow money from the bank. Now, if you know nothing about mortgage rates, 3.5% is historically considered low. If you were to borrow $500,000 on a 30-year fixed mortgage, your monthly payment on this loan would be $22.45 a month. At a 7% interest rate, however, your monthly payment becomes $33.27, or about $1,100 more per month just on the higher interest rate alone. Make sure you remember these 3.5% and 7% numbers because they will be important in just a little bit. Now, at the onset of the pandemic, what we had was just some widespread economic panic among just overall panic in the market because of the unknown. And people were hoarding supplies such as toilet paper, and the economy shutting down meant that money would not be changing hands. If money stops changing hands, people would lose their livelihoods and their jobs. As a direct result of this economic shutdown, the Federal Reserve and the government enacted massive stimulus packages into the economy, and they also decreased the federal funds rate. That rate is the cost for banks to borrow money from other banks, so they lowered the federal funds rate by a total of 1.5% at their meetings on March 3rd and March 15th of 2020. These cuts lowered the Fed funds rate to a range of 0 to 0.25%. With rates that low, that means the cost to borrow money became cheap. When people can borrow money and not have to pay any interest on it, they naturally will just borrow more. More money allows for the expansion of business, and more spending naturally occurs because people are willing to make large purchases with that borrowed money. This spurs economic activity and is overall a good thing for most people. The stock market and asset prices like real estate go upward. This is good for a short period of time, but nothing that great lasts forever. The other thing going on at this time was that the Federal Reserve was buying US Treasuries and mortgage-backed securities. I can explain more about these in a different video, but essentially mortgage rates are determined by the price of mortgage-backed securities, the prime rate, which is affected by the federal funds rate, and a whole lot more. The Fed bought over $1.3 trillion of mortgage-backed securities from March of 2020 to March of 2022. This insane level of buying by the Federal Reserve drove mortgage-backed securities market to the moon, leading to record low yields, which then also resulted in record low mortgage rates. In July of 2020, mortgage rates fell to below 3% due to the Fed funds rate change and the purchasing of MBSs, and ultimately hit lows of around 2.65% in January of 21, according to this graph. So homes were cheap to get mortgages for, and what happens when mortgages are cheap? Do you know? Well, the easiest explanation of how interest rates affect the housing market is from Investopedia. Quote, low interest rates tend to increase demand for property, driving up prices, while high interest rates generally do the opposite. Now notice how I said generally. This is a foreshadowing for the rest of the video, so stay tuned. As of right now in 2022, because the Fed exited the mortgage-backed securities market, and due to inflation running rampant at 8% and the fears of the economy going into a recession, the Federal Reserve has had to act more aggressively. The Fed and Jerome Powell decided to raise the federal funds rate and even made the most aggressive interest rate hikes since 1994 with a 0.75% hike in one Federal Reserve meeting. Their main hope is to control inflation, which seems to be the most pressing economic matter right now. By increasing rates, the Fed is hoping that buying behavior across the United States slows down, resulting in less demand for goods in person and bringing inflation down. This is best illustrated by a small business example, so let's pretend that you own a donut shop and you want to expand that donut shop. Personally, I'm a glazed donut guy myself, but if you wanted to offer a full coffee bar in addition to your donuts, you need the funds to expand your business. When interest rates are low, you might be willing to borrow some money to do that, especially if the bank is giving you a loan to the tune of less than 3%. So you borrow $100,000, you create a full coffee bar with that $100,000, and you might have to hire some contractors, you have to buy coffee machines, coffee beans, etc. All the money that you spent is going straight into the economy, and that is increased revenue for the entire supply chain. If you think interest rates are going to go up, you won't pull the trigger right away on a loan. You might think twice about borrowing that $100K, and you might wait for a better time in the market. That should lower the overall demand for goods. So that's the intention of raising interest rates, is to lower overall economic demand of goods and hopefully lower inflation. But the increase in the federal funds rate also meant that mortgage rates are going to be affected as well. We're already seeing those mortgage rates reflected across the board in the housing market. So according to Freddie Mac, at the beginning of 2022, the average 30-year mortgage rate was 3.11%. At its peak in late June, the rate was 5.81%. Now, higher interest rates generally decrease demand for property, thus lowering prices, but our situation this year in 2022 is a little bit different. On whether or not the housing market will collapse, the answer is a little bit more nuanced than just yes or no. There's a possibility that the housing market actually stays decently strong relative to other investments, such as stocks, bonds, and commodities. And one thing most people will agree on is that the housing market will at least cool down from where it is right now. Housing affordability is increasingly becoming a huge challenge for many families. So the National Association of Realtors has a housing affordability index, and it's currently at lows never seen before, completely free falling this year. In this chart, the lower the number, the less affordable homes are. You can see that in January of 2021, when mortgage rates were at their lows, affordability was much higher. But now that chart has completely changed its tune. In October of 2021, about half of Americans said that the availability of affordable housing was a major problem where they live, a bigger problem than the availability of jobs, drug addiction, crime, and racism. In that same survey, 70% of Americans said young adults today have a harder time buying a home than their parents' generations did. This unaffordability, according to data, is due to limited supply unable to meet rising demand, resulting in higher prices. Over the past 3 years, home listings are down overall about 54%, and at the same time, the prices of sold homes in the United States has increased by over 45%. But here's another interesting question. We know that interest rates are going up, so that should cool off the demand for homes. But with the low supply that we're facing, will that lower demand mean anything for prices? Let me use another simple example. Let's say there are 80 farmers looking for new John Deere tractors, but there's a problem. There's only 20 available for sale. That means there are 4 farmers in the market for every 1 tractor. Now let's pretend the store selling the tractors magically makes half the farmers disappear from buying them. That still leaves 40 farmers for 20 tractors, a ratio of 2 to 1. In other words, if home prices are going up because of high demand, then raising interest rates could help bring prices back down as the cost of borrowing increases. But if prices are going up primarily because supply is too tight, like in our tractor example, then raising interest rates won't be that impactful. But there's something I've researched that may make you think twice. So a recent study by the Fed found that the demand played a larger role in home price appreciation, not supply. Quote, fluctuations in demand explain essentially all of the variation in home sales and 80% of the variation in prices between 2002 and 2021. Since new construction typically accounts for about 15% of supply, our estimates imply that new construction would have had to increase by roughly 300% to absorb the pandemic-era surge in demand. Basically, what they found was that because housing demand was so incredibly strong, there was no way increasing supply could have prevented such massive home price appreciation. Thus, reducing demand should be the short-term focus rather than increasing supply. Plus, increasing supply will take years anyway. So this can help explain why the Fed wants to raise their Fed funds rate, because that will indirectly result in a higher mortgage rate, which can tamper down demand. As the study from the Fed states, quote, we estimate that a 1 percentage point increase in the mortgage rates lowers housing demand by 10.4%. So since mortgage rates have had their largest yearly increase ever, that should mean that demand should also have near record declines. I decided to take a look at the existing home sales and new home sales in the US to see if there were any big changes this year. Both existing and new home sales have had their their largest yearly decrease since the global financial crisis in 2008. So clearly, demand is decreasing and at a pace consistent with the Fed's estimates. With inflation still so high, the Federal Reserve is going to continue to raise interest rates. In fact, the market is pricing in 4 more rate hikes in 2022, which means that we could be seeing a 7% mortgage rate by the end of the year. So remember when I mentioned the 3.5% versus 7% interest rate at the beginning of this video? That might actually become a reality for many home buyers by the end of 2022. Lastly, why is it possible that the housing market actually stays decently strong relative to other investments like stocks, bonds, and commodities? The reason is the structurally high demand and over 10 years of underbuilding of homes in the United States. So this graph on the screen represents underbuilding versus overbuilding of homes in the US. Anything above the blue line indicates overbuilding, and anything below the blue line shows underbuilding. From around 2001 to 2008, you can see the number of homes being overbuilt before the 2008 crisis. You can see that right before the crisis, we were building almost 2 homes for every 1 home that we needed. Now, since that recession, you can see that from 2009-ish till now, we have been underbuilding homes this entire time. According to Realtor.com, there are 45 million millennials in their first-time home buying ages, and there's a deficit of around 5.24 million homes through June of 2021, and that number is likely larger now. So while demand is falling for now, the long-term need for more housing is still there. People are just waiting for the market to cool down. You'll see that many Americans are back living with their parents, and the data shows that many people are choosing to live with their family because it's more cost efficient. So because there is so much long-term demand for housing, even though the market may cool down and decline in the short term, the long-term outlook for housing is still quite positive. Any decline in mortgage rates and home prices will bring eager buyers swooping in quickly. So I'm personally in the market for a starter home, and I'm sitting on cash waiting to see if home prices come down in the next 6 months if interest rates continue to go up. With little demand, I'm hoping that they do come down a little bit, or I might just be weighing my options on investment properties instead. One thing I did want to mention was to make sure to check out my free newsletter, Hump Days, and that's where we cover the market and tech news twice a week on Wednesdays and Sundays. I hope that this video was helpful. Let me know in the comments what you think of the housing market, and subscribe to my channel for more videos like these. I'll also leave up another video at the end right here or right here that you might enjoy. Okay, I'll see you guys in the next one. Peace.